match the following errors on the left with the type of errors on the right. So number one, a cash sale for $700 was recorded as $7,000. So this is H, which is a slide error. Slide error means you put a decimal point too far away on the right. So all of a sudden, instead of showing 700.00, your number is 7,000.0, which is totally different number. So that's a slide error. That's what we call it, slide error. Annual depreciation was calculated using a useful life of 8 years instead of 6 years. That is F, use of improper accounting estimate. So if you estimate 6 years for your useful life of your equipment, then you have to go with 6 years. If you, instead of 6, you enter 8, then that's wrong estimate. You're gonna have a different number. 3, a purchase of supplies was never booked. Oops. If you purchase supplies and you never booked it, you never did the journal entry for purchasing those supplies, then that's an omission of the journal entry, which is gonna mess up the whole financial statement. Number 4, a 740 customer check was recorded as 470. So as you see, these two numbers are changed. 7 and 4 now became 47. So that's a G, which is transposition error. Transposition error means you transpose 2 digits. That transposition error can be transposed anywhere. Let's say the check is 740 and you enter 704. So you transpose the first 2 digits, right? But here you transpose the digit 3 and digit 2. So that's why it's 47. So the transposition error can be at any location, not necessarily just the first 2 digits. Payments for an ad was debited to utilities expense. So that's a C. If it's an advertisement expense and you put it in the utilities expense, that might be something like classification error. You misclassified your expense. Instead of recognizing as advertisement, you recognize as utility. It happened to me that I was looking at the financial statements of my company that I was running, and I saw, let's say, wait a moment, utility expense is so high. Why my utility expense is so high? And at the end of the year, I had to go back through my journal entries, and I realized in 1 month, let's say, for advertisement expense, instead of I debit the advertisement expense, I debit utility expense, for example. And that's why my utility expense was so high. So I went back to that journal entry, I edited that journal entry, make it correct, and I saved it again. And then when I print the financial statement, I saw that, okay, now utility expenses are in normal, acceptable range. At the year end, no adjusting entry was recorded for annual depreciation expense. So you forgot, right? You forgot to do adjusting entry for depreciation expense. That's an omission. You forgot to do it. That's an omission. It's going to mess up the financial statements. On March 1st, a $1,200 check to pay the premium for a 24-month policy was debited to prepaid insurance. Okay. On December 31st, the adjusting entry recognized insurance expense of $450. So that's $1,200 for 24 months. That's $50 a month, right? And starting March, April, May, June, July, August, September, October, November, December. That's 10 months. 10 times 50, that's 500. So on December 31st, adjusting entry recognized insurance expense of only 450 instead of 500. And that is accrual or deferral error, because here you paid policy in advance, you put it in prepaid insurance, you recorded that as deferred, deferred expense. You deferred the recognition of expense to future and recorded as an asset. So you deferred the recognition of expense to future. And now at December 31st, you have to recognize how much of this deferred expense, insurance expense, needs to be recognized as insurance expense. So you recognize only 450. So that's a deferral error. Okay. Deferral adjusting entries means you defer the recognition of paying cash or receiving cash to future. So you defer the recognition of revenue or you defer the recognition of expense. So when you defer the recognition of revenue or expense after paying cash, that means at the end of the year, you have to record and do some deferral adjustment. Make sense? So deferral adjustment means you paid or received cash in the beginning of the year, and you deferred the recognition of expense or revenue to future. But in accrual adjusting entry, that means there was no cash paid or received, but something happens, like passage of time. For example, you have a loan that you have to recognize and pay interest, but because of passage of time, something accrued. Like what? Like interest expense accrued. So that's an accrual adjustment. That means because of passage of time, something's accrued, and you need to recognize interest expense. Or let's say you sold insurance policy, and because of passage of time, something accrued, which is recognition of revenue on selling insurance policy. So that's an accrual. Has nothing to do with paying cash or receiving cash, but something accrued. Make sense? And anything is accrued needs to be recognized, either revenue accrual or expense accrual. Any questions so far? Okay. Match the following errors on the left with the type of errors on the right. So I'm just going to show you the answers here. I explained already what those type of things are. There's nothing new in here to, again, go over. So you can just look at the answers and try to see if it's matching with your answers or not. So I'm going to pass this one. Okay, in regards to bank reconciliation, it's very important because you have a part of your group project that you need to do bank reconciliation at the end of the month. So if at the end of the month you are doing, you received your bank statement, then you need to do bank reconciliation. So indicate for each of the following whether you must adjust the bank balance or the ledger cash account in your monthly reconciliation. So when you do bank reconciliation, you need to, there is two parts in the bank reconciliation, either left or right, or top and bottom. Let's say left and right. Let's say you divide your bank reconciliation into left section and the right section. The left section, let's say, is your book, and your right section is your bank. Now, you have a bank statement that shows you have a dollar amount on it, whatever. Let's say $100,000 bank statement shows that you have $100,000. But then you look at your cash ledger key account, and you see for your checking account, you have only $90,000 balance. But you look at your bank statement says, no, you have $100,000. So there's a difference, right? Something is wrong here. Something is not matching. How come your bank statement says you have $100,000 and your key account cash checking account says you have $90,000? So in this situation, you have to look in your bank statement to see what's going on in your bank statement, and look at your T account and see what's going on in your T account, and start reconciling all those numbers that are matching. But there might be some stuff that are not matching. And those are things that you need to either add or deduct from your book or from your bank, okay? So add or deduct to your book, or add or deduct to your bank. There are a few things that needs to be added or deducted from your book, and there are a few things that might be needed to be added or deducted from your bank statement balance. So which one is what? There are one thing that here says debit memo. Anyone, or here says credit memo. Okay. So let me, and this is for you to understand the debit and credit memo. There will be no college teaching you this or any other class. So it's better to learn right now and take a note and try to understand. So here is an example that you go to Bank of America and you get inside the bank and you tell to the teller that I want to open a checking account. So Bank of America, this is the T accounts that Bank of America has, right? Bank of America has an account which has a lot of money inside, right? So it's a rich bank. So they have a lot of cash. That's why I put XXXX. So they have a lot of cash. But you tell them, I want to open a checking account. And they are so happy to do that for you. So immediately they open a T account for you. And they call it checking account number 1, 2, 3, 4, 5, 6. That's, let's say, account number that you have for the checking account. And you give them, let's say, $1,000. And they debit their cash because you give them $1,000. And they credit your checking account. So they credit your account. Make sense? So when someone is working in a bank and they say, oh, I credit your account for $1,000, that means your account now has $1,000 balance. Does anyone know why this is $1,000 on the credit side? No? Because this is a liability. So bank technically owes you $1,000 because you gave them $1,000. So they owe you $1,000. So this account shows that they have a liability. So this is a liability account. And normal balance for any liability is credit. Liability, credit, liability, credit. So here is a credit. So they credit your account. That means now they recognize that they are liable to you, and it's a liability account. So then let's say, you give this checking account to your utility company your business utility company, and your utility company now is authorized to deduct automatically from your account monthly basis for, let's say, internet. Okay, so they're gonna deduct, let's say, $75 automatically every month from your checking account that you open for your business because you gave them that authorization. So they're gonna take $75. So they're gonna technically take, bank gonna give $75 to utility company, and your account goes down by $75. Got it? And let's say this Bank of America is a very nice bank, and at the end of the month, they give you $2 kind of, interest because you have a business checking with them, and they want to say you have some balance, and that's why we want to give you 2% interest for your balance that you have. So they're going to give you $2 interest. Now you have $2 more money, and that $2 for Bank of America becomes interest expense, which is $2. So Bank of America now has $2 interest expense. That's debit expense, and credit to your account. That means you have $2 more money in your account. And then Bank of America or any other bank, at the monthly basis, they charge your bank for, having a checking account. Let's say $20 a month. So they're gonna charge your bank $20 a month, so you have less money now, and they recognize bank fee revenue. So they charge $20, they recognize bank fee revenue, which is a revenue for a bank. That's why they have a bank, right? They don't work for free. So that's how they make money. They charge your account for $20. Your account goes down, and they have a revenue to recognize. Normal balance for revenue is credit. Normal balance for expense is debit. So everything so far so good. That's what we learned. Now, how much money do you have right now? So you have $1,000 in the beginning that you open your account, minus 75, minus 20, that's minus 95, right? And because you have a $2 here, so plus 2, so it's minus 93. So $1,000 minus 93, help me a little bit. That's $907, I believe. Okay. Now you get your bank statement. When you look at your bank statement, then you see, wait a moment, there's a surprise here. I got $2 interest from bank. That's a very good news, right? Watch. That is a very good news for you, right? And you are so happy. And that's a credit memo. So a credit memo in your bank statement, it's a good news for you. It's a good news because now you have more money, right? It's a surprise, but it's a good surprise, right? So you have a credit memo, and now you add it to your book balance because it's a surprise. You didn't know about it. Now you see that credit memo, and you add it to your book balance. So add to your book. Got it? Any questions so far? So credit memo in the bank statement, it's a good news, it's a surprise, but good news, and add it to your book. God bless, right? However, you look in your bank statement, you see a debit memo. Debit is on the debit side, right? Here is the debit side. So you see a debit memo, and debit memo is a bad news. Debit memo is a bad news because they got money out of your account. Your account has less money. It's a surprise, but it's a bad surprise. So we call this a debit memo because it is on the debit side. We call this one, it's a credit memo because it is on the credit side. Now you understand why why we call it debit memo and credit memo, because in the T account, in the Bank of Statements, Bank of America general ledger, it is literally on the credit side. That's why you call it credit memo. And it is on the debit side because of that, you call it debit memo. So the debit memo, that means you have less money. So you deduct during bank reconciliation, you deduct from your book. Got it? Any question? Okay. Take a picture. This is the first time and the last time you're going to see someone explain you the debit memo and credit memo the way I did. Okay. Looks like we are good. Okay, let's go back. So what do you do with the debit memo? With the debit memo, as I said, debit memo is a bad news. It's a bad surprise. You see in the bank statement, a bad news. So on your bank reconciliation, you deduct it from your book balance. A deposit in transit, what does it mean? A deposit in transit means you deposit a check or few checks in your bank ATM machine on the last day of the month after hours, right? And you think you're good, right? You did your bookkeeping, you deposit the check on time, everything looks good, right? From your point of view, your bookkeeping is good, you did deposit your check, everything is fine. But from bank point of view, bank says, okay, that will be updated tomorrow morning, and tomorrow morning is what? It's the next month, and it will get updated into next month bank statement. So a deposit in transit, that means a deposit that your bookkeeping is perfectly fine, but the bank statement is not updated for that. But you know you did your bank deposit. So add it to your bank statement balance, because in reality, you know that you did it. Just is not updated in the bank system at that moment. So next month you will see it in your bank statement, but for this month bank statement, it's not there. So you just add it manually during bank reconciliation to your bank balance. Any questions so far? Bank service charge means it's a debit memo. A debit memo, it's a bad news. It's a bad surprise. And you have to deduct it from your book, okay? Debit memo, a bank service charge debit memo, you deduct it from your book. A credit memo, it's a good news. So a good news in your bank statement, we call it credit memo. And that is something that you need to add to your book. It's a good news. You add it to your book. An NSF check, again, it's a debit memo, because an NSF check means your account has been debited in the Bank of America T accounts. So that means you have less money. Non-sufficient fund check means a check that you deposit maybe, I don't know, a few days ago, a week ago, and it went and bounced back because whoever gave you that check, he didn't have enough money in his account. So the check bounced back. If the check bounced back as an NSF check, so the bank will take it out of your checking account. Remember, when you deposit, the bank will give you, increase your account. Now, because it's bouncing back, so the bank will deduct it from your account. So that's a debit memo. It's a bad news. So you have to deduct it from your book. An outstanding check. An outstanding check, it's a check that you wrote to your vendors, and not all of them has been cleared. One or two checks still is not cleared from the bank system. That means your vendors, they didn't deposit that check yet. So even though you did your bookkeeping correctly, you deducted it from your checking account correctly, you recognized it correctly, but the bank has no idea such a check exists. So it's okay. For now, you just manually deduct it from your bank statement balance because it will get cleared eventually anyway, right? Unrecorded interest. Unrecorded interest, it's a credit memo. It's a very good news. It's a credit memo. It's a happy face. So add it to your book. Good surprise. Add it to your book. Credit memo. Same thing. Collection by the bank of a note receivable from a customer with accrued interest. So your bank, on your behalf, collected a note receivable from a customer, including the accrued interest. So it's a good thing, right? So it's a happy news. It's a credit memo. So that's good. So you have to add it to your book. But when you add to your book, make sure you record how much of the principal of note has been reduced and how much of accrued interest needs to be recognized as interest income. So when you are recording, your principal of note receivable goes down, cash will be debited, obviously, and accrued interest needs to be recognized as interest income. Any question, please? Okay. So below are items for October 2020 that you are seeing for the first time. Indicate which with a check mark whether each item should be added to or subtracted from the bank balance, book balance, or neither. Okay, so here we go. Remember, whatever I have here in the highlighted area, the book balance needs to be journalized after bank reconciliation, okay? Because when you do bank reconciliation and something has been added or deducted from your book, that's just a bank reconciliation. It's a piece of paper. So you have to do the actual journal entry, so adjusting journal entry. Same thing in your project. You have to do bank reconciliation, and then using your bank reconciliation, you have to do adjusting bank reconciliation journal entries. So interest earned on bank cash balance, that's a credit memo added to your book, which needs to be journalized later on. Bank service charge, that's a debit memo. It's a bad news, but it needs to be deducted from your book and be journalized down the road. NSF check from a customer, that's again debit memo. It's a bad news. So you have to deduct it from your book balance and obviously needs to be journalized. A night deposit made on October 31st when the bank was closed, that's a deposit in transit, needs to be added to your bank balance. And there is no journal entry for that because your bookkeeping is perfect. Just the timing that you deposit in the bank was at the last day of the month, after hours, in the ATM machine. So your bank system is not updated. That's why it's not showing in the bank statement. Check written and mailed October 31st. If you write a check and mail it on October 31st, definitely it will be outstanding checks, right? And outstanding checks needs to be manually deducted from your bank balance. Your bookkeeping is perfectly fine. Just the bank doesn't know about it. So you just deduct it from the bank. On October 12th, deposit appearing on the bank statement as made on October 13th. That's fine. If your bookkeeping says October 12 and then bank says October 13, who cares? It's in the middle of October anyway. So there's nothing to do about it. That's fine. you just need to check the dollar amount on your bank statement with the check mark on the dollar amount on your checking account, and everything is fine. So nothing to do. Another firm's check charged to yours. Wow, that's a mistake. That's an error. So you need to call to your bank. Let them know that they have a mistaken charge on your account, and probably they're going to investigate that and fix that in next few days. But for now, you just add that amount to your bank balance because it was taken from your account by mistake, and it's the bank mistake, it's not your mistake. Payment of a phone bill that appears on the bank statement but was never recorded. Okay, that is like that automatic deduction. Remember I said you give your checking account to your utility company and say, monthly format deducted from my account, whatever it is. So when you get your bank statement, you see, oh, the bank statement shows a phone bill has been deducted, or internet bill has been deducted, or electricity bill has been deducted, or water bill has been deducted. So whatever it is, that's an automatic withdraw from your account. So it's a so-called debit memo. It's a bad news, and you have to deduct it from your book and do adjustments after you finish your bank reconciliation. Collection of principal and interest on a customer's note collected by the bank. That's a good news. That's a credit memo, right? So you add it to your book that you collected this much money, so your account goes up, and you record a journal entry to recognize what was that amount collected for, and what is, if there's any revenue to recognize or anything, or reduction of principal because it's a note. Any question? Nothing? Okay. And here is the journal entry that you need to recognize for each of those parts that is in the highlighted area, right? Those things needs to be recognized. And this is the journal entry. So if you got interest income from the bank, so you debit cash to increase your cash account, and you credit your interest income to record the bank interest you received. If you paid for, let's say, bank service fee, that means your bank deducted money from your account for bank service fee. So you have to record it as either bank service fee expense or call it miscellaneous expense, whichever you like. I like to call it bank service fee expense because it's more specific. Miscellaneous expense, I'm going to leave it for something that I really happens once a year. It's not a big deal, and I put it in a miscellaneous expense. But bank service fee normally, I think it's not happening once a year. It's actually happening once a month. So if that's the case, I like to call it, put it in a separate T account, call it bank service fee expense, and cash will be credited. Accounts receivable, if you receive any payments, let's see, what is C for? NSF check. So if it's an NSF check, that means the accounts receivable for that bad customer. So accounts receivable dash Mr. Bad Customer will be debited. So accounts receivable goes up for the bad customer again. So it's going to go up. And cash will be credited to reduce the cash that you have in your account. And then you call this bad customer and tell him, hey, what's going on? Your check has been bounced. You not only you have to pay me that, but also you have to pay for the bank service fee that they charge me $25. So you try to also collect that. Utility expense. If it's automatically withdraw from your account and it was a debit memo, that's fine. So now you recognize expense for it, and cash will be credited to reduce the cash. In regards to note that you collect, the bank collected on your behalf, so cash will increase, that's a debit, but note receivable will be credited to reduce the principal of the note that someone owes you. and also the interest income that has been collected and accrued, that has to be recorded as interest income. Any question, please? Anything, don't be shy. These are a lot of information I'm just pushing through. Questions? Okay. So here we go. Company, as of June 30th, the company ledger's cash balance is showing $31,466. That's the T account, cash balance. The June bank statement balance, however, shows $70,616. Totally different number, right? And includes the following items in the bank statement. Bank service charge, $50. NSF check return, $2,300. Note collected for company by the bank is $25,000. Interest on the note collected by the bank is $2,500. That needs to be recognized as interest. Outstanding checks as of end of June are $21,000 checks outstanding. That means you wrote the check, you record the check, but the vendor didn't, deposit yet. Probably it's not clear from your bank. Deposit in transit at the end of June is $7,000. That means at the end of June, you went to bank after hours, you deposit this check in the ATM machine. Guess what? The bank system is not updated, therefore is not showing in the bank statement. So you have to just manually add it to the bank. So here is the bank reconciliation, and this is a good sample what you need to do for your group project. So you write the company name, and at the top, in the middle, you call it bank reconciliation, and below it, you put a date. So company name at the top, in the middle, bank reconciliation, the line below, the date. And then you have two sections, balance per bank, balance per book. So here they put it under each other. So you can either put it side by side or under each other. So here is under each other. So you say my bank says I have $70,616. My book says I have $31,466. And then you have two sections, add, deduct, add, deduct. What do you add to the bank? If there is a deposit in transit, here, deposit in transit, right? That means your bank doesn't get updated yet. So you want to add it manually. So here, manually, you will add it to the bank, okay? Outstanding checks, that means you wrote the check, you recorded properly, your bookkeeping is perfect, but the bank doesn't even have any clue that such a check exists. So for now, manually again, you deduct it from your bank balance and you get to final answer, which is corrected cash balance as of June 30th for $56,616, $sign, double line. Then you go to your book side. You say, okay, I received a note receivable collection by the bank for $25,000. Also, bank collected another $2,500 for the interest that accrued for this note receivable. So that's another $2,500 that will be added to your book. But there's a bad news also. So the bad news is you have an NSF check. So the bank took $2,300 from your account because of that bad check. And also the bank charged you $50 for that, right? And that $50 might be, let's say, $30 for NSF check and $20 regular monthly fee. Make sense? So, but total bank service charge ends up to be $50. Now that $30 that you paid for NSF check, you will try to collect it from your client, okay? But the $20 is definitely yours as a monthly bank service fee anyway. So add and then deduct, and then you end up with 56,616 $ double line, and that's exactly close to your bank balance. So there is nothing missing, and bank reconciliation is one of the most useful type of internal control that a company can do on a monthly basis to find out about mistakes, employee fraud, fraudulent charge, fraudulent activities in the company, or anything else. Bank reconciliation is one of the best of it. Best tools you can have. It's free, you can do it, and it will find out so many mistakes and fraudulent activities in your account. Now, bank per book, whatever you did in here needs to be journalized. So here we go. We journalize the note receivable. So you record a cash debit, $25,000, and credit note receivable for $25,000. You journalize that. You also got another $2,500, and you credit that for interest income, $2,500. Now, the situation that I suggest to match it with your bank statement is this. If your bank statement showing $27,500 cash debit, then in that case, you need to, not need to, but I suggest to do it that way, to combine these two journal entries so you can match it exactly with your bank statement. In that case, you debit cash $27,500, you credit note receivable for $25,000, and you credit interest income for $2,500. That will be just one journal entry in one piece. And that $27,500 cash, it will match with your bank statement, dollar to dollar. But if your bank statement is showing $25,000 separately and $2,500 separately in separate lines, then do it this way. Okay? Any question? The reason you want to match your bank statement, because in case you are auditing something in future, a month from now, 6 months from now, the numbers are in your bank reconciliation are exactly, and your journal entries for the bank reconciliation are exactly matching your bank statement dollar amounts. Okay, for the NSF check, you go and you debit accounts receivable dash Mr. Bad customer, $2,300, that goes up. And you show that you have less cash of $2,300. That's a credit. And in the bank service fee expense or miscellaneous expense, you debit $50 for the service charge, and cash will be credited. That's a debit memo. Okay? And that's another debit memo. Any question? Okay. On July 31st, RIDCO's ledger cash account balance is $25,110. Its bank statement balance, $27,620. Obviously, cash balance and bank balance is not matching, right? Use the data below to reconcile the two balances as of end of July. Checks outstandings are $6,300. Check 244, check number 244 to pay the June gas bill was correctly written for $270, but recorded on the RID's books as $720. You see, that's a transposition error. Whose error is that? The bookkeeper's error, the company's error, not the bank error. The bank is good. So you have to fix your books because of that error. That's your error. That's your company's error. So bank is good. Just fix your error. $60 for safe deposit box, but Ritz does not rent one. Oh, that's a bank error. Bank, by mistake, charged you $60. That's a debit memo of $60 in your bank statement. You need to call to your bank, let them fix it. But in the same time, you need to manually add it back to your bank statement. The debit memorandum for $200 for a $175 NSF check and $25 bank NSF fee. So you see a debit memorandum of $200 because of those two issues. So that's a debit memo. Bad news, you need to deduct it from your book and also journalize it. Debit memo, $40 debit memo for bank service. Reed is seeing for the first time. Okay, that's a debit memo. It's a bad surprise for bank service fee, so it needs to be deducted from your book and needs to be journalized. July 31st night deposit of that day, cash receipts of $3,940. That's not in the bank statement. Obviously, it will not be in the bank statement because it was deposited at the end of the month after hours, and bank statement for the month of July will not show that. It's not updated. It will get updated the next day, but that's August anymore. So it's going to be the next month bank statement. So that needs to be added manually to your bank statement. Prepare its bank reconciliation. So here we go. Company name at the top, then bank reconciliation, name of the report in the middle, and the date after that below. Then you have two sides, bank statement and book balance. Bank balance and the book balance. Add, deduct, add, deduct. So bank says you have $27,620, but you had a deposit in transit done at the last day of the month after hours, so you manually add that to the bank. And you call the bank, let them know that there is a mistake in the charging your account for a safe deposit box, that you never had such a thing. So they said they're gonna fix it. So for now, you add it manually back onto your bank statement balance. At the last day of the month, probably you wrote few checks, and some of those checks are not cleared yet. So outstanding checks number 1 or 1 or 2, or whatever the check number are. So those checks, you can write them in here, and will be total $6,300 outstanding checks. So corrected balance will become $25,320, $sign double line. For the book, you made a mistake. The mistake was this. You said the correct balance was $270, but you record that for $720. So $720, too much gas bill, too much utility bill, right? So your utility bill has to go down, and the difference is $720 minus $270 is $450. So your utility bill has to go down. For now, just add it back to your account, $450, and we journalize it down the road. For NSF check, you got an NSF check of $175, so deduct it from your checking account. And because of that NSF check, the bank charged you another $25. You need to deduct that. And also you have regular monthly bank service charge, which is, you need to deduct that also. Those are all debit memos. Bad news, debit memos. Add them up, $25,320, double line, $sign, and that's the same as here, $25,320. So we are good. However, whatever you have in this book side needs to be journalized. So you journalize that you have more cash for 50 and your utility expense that you recognize too much now goes down, credit. So you credit your expense to reduce it because you recognize too much. Got it? Accounts receivable for Mr. Bad customer. So accounts receivable dash Mr. Bad goes up $175. Miscellaneous expense or bank service fee expense will be debited $25. And cash will be credited exactly $200 that the bank took it from your account. Okay. If the bank took as 175 separately and took 25 separately, then you do this journal entry separately. So you do accounts receivable, debit 175, cash debit 175. Bank service fee, debit 25, cash debit 25. But if the bank statement shows $200 one piece number, then you do journal entry like this. Miscellaneous expense or bank service fee expense will be debited for $40 and cash will be credited for $40. There is one more problem, number 5, which I want you to do it. I'm not going to show you the answers today. I want you to do it yourself based on practice that we did above. And next week, I will go over this problem with you again. But I want you to do it first. And then next week, I will show you my answers. And then you check with your answers and see where you made a mistake and learn from it. Okay? So we covered section 1 and section 2 up to problem 5. Questions? Okay, don't miss me. See you next week. Bye-bye.